Welcome to Fraud in the Financial Statement Audit, Auditor Responsibilities under New SAS, a production of the AICPA Professional Development Division. This course's objective is to provide information and guidance on the implementation of Statement on Auditing Standards 99, Consideration of Fraud in a Financial Statement Audit. The Auditing Standards Board's fraud standard is effective for audits of financial statements for periods beginning on or after December 15, 2002, and supersedes the earlier fraud standard, SAS 82, of the same title. Our moderator is Michael J. Ramos, CPA, Denver-based author of AICPA publications and courses on such topics as the fraud standard, staff training, independence, professional ethics, construction contractors, real estate, and the attestation standards. Joining him are Mark S. Beasley, PhD, CPA, Associate Professor of Accounting at North Carolina State University in Durham, and member of the Fraud Task Force of the Auditing Standards Board. Joanne Golden, CPA, partner of the Central New York CPA firm of Dermody, Burke & Brown in New Hartford, and president of the New York State Society of Certified Public Accountants. And Elliot Leary, CPA, Director of Forensic and Litigation Services at KPMG LLP in Washington, D.C. In Segment 1, Mike, Joanne, Mark, and Elliot will provide an introduction and overview to the fraud standard.
Hello, and welcome to today's program on the new fraud auditing standard. My name is Mike Ramos, and I'll be serving as the moderator of today's panel discussion. And joining me in studio today are Mark Beasley. Mark is a professor of accounting at North Carolina State University, and he writes extensively on auditing and accounting matters in general, and fraud and its relationship to auditing in particular. And Mark has been a member of the task force that wrote the new fraud audit standard, and he's spent the last 2 or 4 years working on this standard, so we're delighted to have him today. To Mark's left is Elliot Leary. Elliot is a partner with KPMG, and before joining KPMG, he was with the FBI, where he specialized in financial fraud investigation. Since retiring from the FBI, he's been working with KPMG to implement the new fraud standard and to train KPMG personnel in forensic accounting techniques and fraud auditing standard. Elliot is also a CPA. And to Elliot's left is Joanne Golden. And Joanne is the president of the New York State Society of CPAs. And she is also the managing partner of a 100-person firm in upstate New York, and has had some discussions with the quality assurance partners within her firm about how to implement the standard and what the new standard means for small practitioners. I'm really delighted that everybody's here today, and I think you bring a wealth of experience, and it's really a pleasure to have you all here to talk about the new standard.
Thank you.
Mark, I'd like to start with you as the member of the task force. Can you give us a little bit of background on why the standard was developed? It seems that the list of standards on auditors and their responsibility for fraud has a long and storied history. And now here we are at a new standard. Can you tell us a little bit why this one was developed and what it is that you were trying to accomplish?
Sure. The new project actually was created long before what we've experienced in the last year. In the exposure draft phase of SAS 82, the Auditing Standards Board committed to look at its effectiveness, I think by the year 2000. So back in early to mid 1998, a group was created for the Auditing Standards Board to consider conducting some research related to SAS 82's effectiveness. So the ASB committed to study its effectiveness, and so some academic research was commissioned on behalf of the Auditing Standards Board to look at SAS 82 and how it was doing and how it was affecting practice. Not too long after that, the Public Oversight Panel on Audit Effectiveness released its report in 2000, which had an entire chapter devoted to really focusing in on the auditor's responsibility for material misstatements due to fraud, and with a a series of recommendations for the Auditing Standards Board and others to consider to sort of significantly improve auditor performance in auditor detection of fraud, material misstatements due to fraud. So you had the research commissioned in late 1998, the POB's oversight panel created in 2000 really provided some foundation to really start considering it. And then on the heels of that, the task force was created officially in September 2000.
Okay.
And that was right a month before the Enron news started breaking. And so the last year has just added more emphasis to the whole environment.
Gotcha. Let me ask you about the academic research, for starters. And can you explain, for some of us, who are not in the academic community, how do you conduct this sort of research? What were you looking for? What did you find?
Well, the research was really commissioned to specifically look at SAS 82 and how well it was doing. Because there's a whole host of research that's been done on fraudulent financial reporting, not specific to SAS 82. So one of the things that the Auditing Standards Board was trying to discover in this commissioned research was specific issues related to SAS 82's effectiveness. Some of the research had been conducted pre-SAS 82 to get a sense for some benchmarking, how well auditors performed before SAS 82. And some of those same researchers were involved in the post-SAS 82 research, which gave the Auditing Standards Board and the researchers some benefit of, here's what the environment was looking like as far as auditor performance before SAS 82. Here's how it looked after SAS 82 to see if we can see any kind of change. So, answering how's the research done, in a lot of cases it's involving specific practitioners in a controlled experimental setting. And then in other cases it's more where we're looking at data and looking at working papers and on a hindsight basis. So we're not really using people, subjects to conduct the research, but rather using data to look at it.
So it's a pretty scientific process.
Oh, very scientific, yes. Yeah. It was, people in the academic world were commissioned to do it, that's their role and what they do often in their jobs. So.
And what were some of the major findings that you found that made their way into the standard?
The new standard.
Yeah.
Well, basically, a couple of things came out of that. One was the risk factors that were in SAS 82. There was a real call for making them a little more discriminatory. That being, can we distinguish a fraud situation from a no fraud situation in the way we describe these risk factors? That there was some confusion when you look at the risk factors as to, well, this looks like it's present in every one of my clients, not just a fraud client. So one of the findings was we need to see if we can't focus more on making them more discriminatory. And then secondly, is there a way to organize them that would be more intuitive as far as trying to assess risk of fraud? Under SAS 82, they were focused under a management characteristics, operating characteristics, industry characteristics. Could a restructuring of those risk factors help auditors in the risk assessment phase? Another finding was looking at when you look at the risk factors, are we good at identifying high risk versus low risk scenarios? And the research showed that actually we have improved since SAS 82. So SAS 82 had a positive impact on how well we identify high fraud risk. Where the real problem kicks in is when you look at the high fraud risk scenario, what do I do about it? How do I respond? Right. And the research consistently showed that's where the difficulty really resides, is what do I do about it once I recognize I may be on a high fraud risk condition? And we struggle as a profession pinpointing the appropriate response. The typical response is to change staffing and maybe to increase sample size. But the nature of the response is where there's a lot of confusion.
Right, right. And one of the things that impressed me with the new standard is the lengths to which they talk. You've tried to make that link for people. You've provided guidance in making that link for people. Elliot, I'd like to talk to you about some of the findings of the POB panel on audit effectiveness, and a couple of things that jumped out at me when I read that chapter that Mark was referring to, and which I think make it into the new standard. Has to do with the use of inquiry and professional skepticism. I think that both of those are really emphasized in the POB panel report and in the new standard. And what I'd like to ask you, as a given your background as a forensic specialist and as somebody who's done a lot of training in this area, how do you take something which is relatively soft, like inquiry or professional skepticism, And how do you train people on that? What do you tell them? How do you make people become more skeptical, or do better inquiries and stuff like that?
Well, it's a mindset, basically, is what you're trying to do, is change an attitude and change behavior. So that when an auditor walks into an engagement, they are adopting a particular mindset, that not to just take at face value anything that's told to them, not to just trust every piece of paper that's put in front of them as being an original, authentic document. And this is, in developing that professional skepticism, it's a conditioning, basically, that has to be done with this, the mindset of the auditor. Some of the ways of training them is by having the person become aware of historical frauds that have taken place, so that they have some background in what potentially they may be faced with in the future. Training towards interviewing techniques where you learn to look for deceptive behavior, increases your awareness that there are people out there whose intent may be to deceive. So all of the more training that you get in fraud and interviewing and those type of things, the more you will adopt a skeptical attitude towards your engagement.
And that's a difficult process. I'm sure, Joanne, you could comment on it, because when you go through the client acceptance phase or the retention sort of reevaluation phase, you hopefully are accepting clients that have that integrity and honesty.
Right.
And so it's a very difficult thing. So I think we lean towards more of a, they are honest, versus we're called to really take a neutral position. And so it makes it very challenging to stay at that neutral position.
One of the things that's very difficult, I think, is what the client versus the staff's expectations are, in terms of really addressing the issue. And I think that what you're saying, Elliot, in terms of how these young staff come in and know what to do, and without sort of upsetting the client, especially when you're dealing with smaller clients, getting that message across as to what we're supposed to be looking for.
Right. Joanne, I'd like to come back to that point, and I think that's an excellent one, which gets into the managing the expectations of the various folks involved and what's required of that. There's one other thing though that I'd like to like to have Elliot respond to, and that is professional is attitude as an audit procedure. Maybe it's not really a procedure, but as we're saying that attitude can be an effective way to detect material misstatement due to fraud. And as an auditor, and I guess I'm a little old school, you're out there and you're vouching things and you're ticking and you're tying, and that's something that's concrete and it's objective and I can get my hands around it. How does attitude help me detect a material misstatement due to fraud?
Well, if you have adopted some extent of this skepticism, the professional skepticism that we're speaking of, then when you get to something that on its face value does not appear correct to you, you're going to use inquiry basically to develop and delve down to the point where you can resolve this item rather than just glazing over it and going on to the things that make sense and being less concerned. All of this really is set by the tone of the engagement at the beginning meeting when they have their brainstorming session, and from the partner of the engagement, managing partner, on down throughout the staff, they need to set this attitude at that point in the engagement.
Yeah.
Mike, there's really two aspects to professional skepticism that Elliot's hitting on, and one is when you go into the engagement, we're supposed to have a questioning mindset that recognizes the underlying aspect of that I think helps with the vouching phase is I recognize fraud is possible in every engagement. There's the potential that it could occur, and I have that questioning mindset that it could be here. Not that I'm concluding it's there,
right,
but I'm walking in with the possibility it could occur. I don't rule it out.
Okay, yeah.
The second phase is when I'm looking at the evidence that I'm using to vouch. The second piece of professional skepticism is that critical evaluation of the evidence, what you're talking about. When it doesn't appear to be, it's not the final document, it's a draft contract, for example.
Right.
to follow up with a more thorough, probing kind of response. So you have that questioning mindset to say, it could be here, and when I'm evaluating that evidence in my vouching procedure, I've got that mindset, and I'm looking at that evidence then more critically.
Right. It's almost like the attitude is sort of a filter for what the evidence comes through, and you look at it and you process it, but you need that filter in there to
Absolutely.
really put it in some sort of context.
Right.
Okay, these various things, we're talking about some shifts here in the way that auditors are approaching things and going into their audit, and that's going to affect two groups. It's going to affect the tone of the engagement team, which Elliot mentioned, but it also is going to affect your relationship with the client, right? And there's some sort of managing of some expectations there. And I guess I'd like to start by asking you, in your client environment, for your clients, what are their expectations for you? If I'm a client and I have a small business and you're going to come in and you're going to be my auditor, what do you think my expectations are about what you're going to do relating to fraud and that whole area?
I think that there's a whole continuum of expectations depending upon the sophistication of the client. The client who's unsophisticated thinks that what you're there to do is to really find fraud. That is the main focus of an audit. Whereas if you have a sophisticated client who really understands what the auditor's role is, that it goes far beyond that's only one component of looking for material fraud and really not, getting to the nickels and dimes that might be missing. So you have an education that you really need to do with a lot of the smaller clients first, to really let them know what their expectations should be realistically. And I think that that's very important, is getting your client on the same wavelength as to what you're going to do for them.
Right.
Because imagine in some cases, if you walked in and said, okay, management, what is your view of the risk of fraud in this entity? They're going to look back at you and say, well, I don't know, that's why I'm hiring you, versus they're recognizing any level of responsibility for that. And I think one of the things in this SaaS that we're trying to do is shift some expectation that management, you are ultimately responsible for fraud risk assessment, that it's not just an auditor responsibility, management and the board, I should say.
That's right. That's right. And particularly in the smaller clients, again, it's a very difficult thing to get that message across because they're so close to it.
Yeah.
And sometimes they're the ones that are performing some of the functions right along with their staff. And so things tend to be perceived by them as convoluted.
I like your use of the phrase education. You said that we have to educate our clients, and I think that's really accurate. And how that process evolves, as auditors start to implement the new standard. Mark, I know that one of the objectives of the new auditing standard on fraud was to change auditor performance and to help auditors become more effective at detecting material misstatements due to fraud. And so I know that there are some procedures in the new standard that are different from the old standard, SAS 82. And as we conclude this first segment here of the video, I was wondering if you could just recap those for us and highlight some of the major changes in the new standard that you think will change the way that people conduct their audits.
Okay. Yeah, Mike, one thing that we should point out is the ultimate responsibility to obtain reasonable assurance that material misstatements due to fraud are detected has not changed. In this new standard, that ultimate responsibility is the same. But there are a lot of other responsibilities within the standard to help us fulfill that, to actually substantially improve auditor performance in that area and fulfilling that responsibility. I really think it comes down to about four aspects. First is the brainstorming kinds of discussion that we will be conducting in the planning phase, where the team is going to be together brainstorming on how could management be engaging in fraud, what might be the incentives to do so, how would they conceal it, and then what should we do to respond to it. And then secondly, setting that culture in that brainstorming session for the engagement team, that professional skepticism culture of questioning mindset that we were talking about earlier. So the first aspect, I think, is that brainstorming kind of discussion at the team level. Then the second thing that the SAS does is it significantly expands the information gathering piece to go into my fraud risk assessment phase. When we think of SAS 82, and if you were to say, what do we do at fraud risk assessment phase, I think most people would think of the risk factors. Exactly. Going down through the checklist of risk factors, Well, that is definitely still one input, but what the new standard is doing is significantly broadening the information set much more beyond risk factors than what we saw in SAS 82. I think the third element is focusing in on what management programs and controls could be in place, looking at that to see how they may be assessing fraud risk, or the particular risk, plural, risk in a plural sense, that could be present there. What's management's programs and controls that could mitigate some of those risks? And then finally, where I think there's a substantial amount of guidance is on the auditor's response phase, which ties into the research that we talked about earlier, where we are struggling there. And so the standard has a significant amount of guidance to deal with the response to fraud risk at a pervasive level for the entire audit, to specific accounts and assertions that may have high fraud risk, and then third, to deal with the response to the risk that management override of controls is always possible. And so there are mandated responses in that section. So that would be the four pieces, I think.
And Joanne, from your standpoint, which of these or all of them, do you think are going to have the biggest impact on your practice? Which ones really stand out?
I think that the brainstorming session becomes the most important thing in terms of the talking about the procedures, because that's really where all of the staff can get together and kind of talk about thinking outside the box, because in that session you're going to talk about how you're going to assess risk and what factors you're going to look at. You're going to talk about the culture of the company that you're dealing with. You're going to get a lot of background out of there. But one of the things that you can do is that you can really step back and utilize during that brainstorming session a lot of the information, or the information that might be available at the beginning of an audit, such as the analytics. You're going to have things perhaps early on in the audit, like journal entries. So you can talk about those in relation to what kind of risks you might see because of those journal entries, and what that will do in terms of management override, what kinds of things could have happened because of that. So that what we're asking those auditors to do is, again, audit smarter, to really think outside the box. And it's that brainstorming session that we're allowed to do that we can really step up to the plate and do that.
Right, right. And Elliot, as you've been helping your firm implement the new standard and have been training people and stuff, some of the things that Mark and Joanne have said, how does that sit with you?
Yeah, they fit right in. When we talk about the brainstorming session, in effect, we talk about look at external factors such as historical frauds that have happened in a specific industry when you're going to begin your audit. Look at things like what's the current environment, what's happening with the competitors in that market. This will set the tone a lot for going in with the staff, so that they realize that there's a big picture here, that you are gauging this firm in perspective to this industry. And then start looking at the internal factors. What is it inside that is driving the behavior within this company? Are they trying to live up to analyst expectations? Is there something going on? Are there incentives and compensation tied to performance? These are the kind of factors that they can look at to analyze the risk at the beginning of the engagement. And then, of course, this is a very set the tone for the whole engagement by having open, honest communication, having a two-way flow of input and feedback from the staff, so that the staff realizes that throughout this engagement, their role in detecting fraud is going to be important, and there's going to be an open door policy up to the management of the audit team.
Yeah, that's interesting. One of the things that I'm taking away from this first session is I think back to some of the audits that I did, and you just roll from one job to the next, and the planning that's done. So you finish up one job, you go out to the other one, and then you end up juggling 3 or 4 at once. And any planning that does get done is really task-oriented, isn't it? It's in my experience, it was all, what's the budget? How many confirms are we going to send out? When are we going to get out to the field? When is the client ready? Those very task-specific, oriented things. And we never talked about, setting a tone or the attitude or anything like that. And I think that that's a really, really good perception, and I hope people, take that away as they start to, because it's going to not only restructure individual engagements, but really the way that you conduct your practice, and how you roll from job to job, and what it is that you emphasize in those meetings.
In segment 2, Mike, Joanne, Mark, and Elliot will discuss the characteristics of fraud.
To help illustrate some of the key elements of the new fraud standard, we've developed a case study for this course in which you'll get an opportunity to actually observe a fraud and its aftermath, and we'll be able to analyze it and figure out how the fraud was committed and how the auditors were able to detect the resulting material misstatement. So right now we're going to cut to the very first vignette in which we'll see in a really encapsulated form some of the elements of the fraud itself, how it was committed, and how the auditors eventually discovered it.
Buying sound machine was the best thing I ever did. Before that, I sold telecommunications equipment for tech2u.com. I didn't love it, but man, those stock options changed my life. One year, I made more money than Michael Jordan.
When Jack bought the company, it was a real change. We had always been a nice, kind of boring place to work, but Jack brought electricity. He had just come from the dot-com world and was full of all this talk about the new economy. It felt like our company was going places.
I had been the partner on Sound Machine for 2 years before Jack bought the company. He was different. He'd made a lot of money at tech2u.com and got out before the stock crashed. He used his money to buy Sound Machine because he said he always liked having a nice stereo and lots of toys. He was like a big teenager, selling electronic gadgets and home theaters. I'd seen him work the sales floor. He loved it.
The problem with most CPAs is they don't understand business. They don't know what it takes to make a sale, grow the business, meet payroll. You tell someone like Norma straight, right? Hey, listen, I've got this problem. I need to show more revenue or the bank will be breathing down my neck. And Norma tells you the accounting rules. I told her, I said, I don't need you to explain the rules. I hire you to tell me how to get around them. And nothing illegal. But like a good tax guy gives you advice on how to not pay taxes.
My first impression of Jack, smart, aggressive, a real go-for-broke kind of guy who never doubted for a minute that what he was doing was absolutely the right thing. Well, he tried to expand Sound Machine. I thought his idea of selling home theater packages to custom home builders, building strategic relationships, that was really smart.
The new economy is all about leveraging the relationship. The old way was to spend an hour with a guy and his wife pitching a $20,000 home theater system. And maybe he buys, maybe not. If he does, you sell him one. One, that's it. And that's inefficient. Instead, let's spend 10 hours with a custom home builder. You build the relationship, work it, be his friend. Have him buy systems to put in every $1 million home he's building on spec. See, now he's got some sizzle to sell, something the other guy doesn't. You give him a price break, give him one to put in his own home. Make him believe that a $20,000 home theater is like a dishwasher. People won't buy a house without one. That's the game I was playing.
There was definitely a change when Jack became the owner. They kept expanding, and we had to audit more and more one-time transactions. And with Jack, you never could get a straight answer. It was like he was always trying to sell me on his vision. We can't audit that. Just tell me the terms of the deal so I know if we've got an accounting issue.
We had problems with documentation on some of the leases with their new facilities. Anytime Jack was included with a deal, it was hard to get signed originals. He was just more of a talker than a documenter, I guess.
Jack was terrible with paperwork. What am I supposed to do with these? One time, he came to me with some sales contracts 2 months after I'd closed the books. I said, Jack, What am I supposed to do with these now? I have to reopen the books for last year. He just told me to do whatever was easiest for me. It didn't matter to him whether I booked them this year or last. Well, after that, I made it a point to start bugging him for his paperwork as soon as we got close to the end of the quarter.
I don't really remember when the bank started pressuring me. Year 2, I think.
In year 3, we noticed that Sound Machine was getting close to violating its debt covenants. Jack had put up his tech2u.com stock as collateral, but of course that was about 1/5 of its original value. I think Jack was getting into financial trouble about that time.
I remember it starting right after year 2. Jack came in with about 5 or 6 sales contracts, maybe $150,000, and said they related to year 2. This time, he was very adamant that they get booked in year 2, even if it meant I had to reopen the books.
Yeah, maybe things changed at the end of year 2. But I don't remember.
This is the best deal available.
Look at it as a businessman. It's December.
Okay.
You're working on the
sure,
guy
I can
trying to
understand
close the deal. It's a big deal.
What do you say?
He has to check around, but you know he's committed. You know he's going to sign. It's just a question of when. It's the holidays. People go on vacation. He doesn't get back, doesn't actually sign until the new year. And for all intents and purposes, that's a December sale. That's when you close them. The signing is just a formality. And no accountant is going to tell me that's a January sale. I mean, how do they know? What have they ever sold? They don't know how the process works. In their world, which is pretty narrow, by the way, they need all the paperwork to say December, year 2, before I get credit for it. Hey, no problem. I'll make sure the paperwork says year 2. You know what I mean?
In year 4, we started to wonder if Irene was keeping the books open after year end. I guess she'd been doing that for a couple of years, but we didn't catch it. You do analytical procedures and you see that there's a big spike in fourth quarter sales, but it's that way every year. And Irene has an explanation, so you don't think there's anything unusual.
We were concerned about the large volume of year-end transactions, but our test work was inconclusive. What happened was, based on some inquiries of client personnel, we expanded our revenue recognition test work to search for side agreements. We found some, and that's how we uncovered the fraud.
What's a side agreement? What's fraud? All I did was keep my company from going bankrupt. I provided jobs for my employees, and I put food on the table for my family. Is that a crime? It's not like I killed anyone. I mean, who got hurt?
You've taught me well.
I'm a salesman.
Impressive.
Very
The customer needs something to make the deal work. I'm going to make the deal work. I'm not going to let the work of a junior accountant bring down my
So I
company.
guess you want me to reopen the accounting books? I booked the sales that Jack told me to book. All the paperwork was there. Then the receivables sat on the books for 4, 5, even 6 months.
We found that Jack had made verbal side agreements with his best customers. The home builders didn't have to pay Sound Machine for the home theaters until they sold the houses. They disguised the transaction by reversing and rebooking the sale every few months. That made the receivable look current and kept us from questioning it.
I never lied to the auditors. Never. And did I make it hard for them to know everything I promised my customers? I don't know, maybe. Who doesn't? All right, let's say you're 15. You have a couple of shots from your friend's parents' liquor cabinet. And not that I ever did, but my brother is that way. So you go home, and your mom asks if you've been drinking. What do you say? Tell me. You say, "Oh, Mom, Tommy's older sister had a drink, and I tasted it." You kiss her goodnight, tell her you love her, and you go to bed.
We're back with our panelists now. And Elliot, I'd like to talk to you a little bit about some of the characteristics of the fraud that we've just seen, and how the auditors detected it and that whole thing. But let's concentrate on the fraud itself. Now, one of the things that's in the new standard is this a framework, I guess, for fraud. It's called the fraud triangle. Mm-hmm. And could you describe that for us, and what the characteristics are and why it's important?
Sure. Well, it's important for an auditor to understand the fraud triangle or basically any model of crime causation like that, because this is one of the things that helps to instill that professional skepticism that we were referring to back in the first segment. There's three components of the fraud triangle. There's various synonymous names for them, but basically they're opportunity, and then there is the incentive or pressure, and then rationalization. And when you have these three components together, you have an atmosphere in which it's ripe for fraud. When you talk about opportunity, that's someone who's in a position where they have something a valuable asset available to them. So, virtually anyone who works in a position of responsibility is going to be in a position to be able to steal or circumvent assets to their own use, whatever. And that's the opportunity that the fraud triangle refers to. When you talk about incentive and pressure, we're talking about the person's perceived need for that asset. What is it that causes them to believe that they should either convert that asset to their own use or perpetrate some other type of fraud, such as a misstatement or something? It can be a thing as simple as need based on a drug habit, alcoholism, or financial distress due to divorce, or some other factor like that that causes your embezzlement, typically a fraud against the company. But then when you start getting into financial statement frauds, the need would be more to make the numbers meet the analyst's expectations. This would be the incentive that's driving the person to commit the fraud. So the last element that comes into play is rationalization. How is it that they can justify their actions? In other words, they have to get up in the morning and look at themselves in the mirror. How can they live with themselves after doing this? And there's amazing ways that people will use to justify their actions. But some of the things are actually things that are controlled by the company. Do they play favorites with one employee over another? This will be something where someone would be able to use a rationalization, such as, I can take this because they're actually giving more to other employees than they are to me. And so there's a lot of ways that this rationalization can come into play. One of the best and the most frequent in the major frauds that we're currently hearing about is, I was just doing what I was told. So these are all of the elements of the fraud triangle. When you understand them, it helps you understand how fraud can potentially take place, raising your level of skepticism. The company can control all of these elements to some extent. Probably opportunity, the best control there is to put internal controls in place that decrease a particular employee's opportunity in order to be able to commit the fraud.
Mm-hmm. And in this case, what we saw a financial statement fraud, and Jack, his incentive, perceived need was the fact that he needed to report certain results to the bank, and so he needed to accelerate revenues. That was the way that he chose to do that. And then, he had all sorts of rationalizations going on. Exactly. And that certainly helped him say, the accountants, they don't understand, I'm not going to let them, do this. Effectively, the deal was closed in December. I mean, who's going to really nitpick
Nobody
that?
got hurt.
Right. Exactly. And as the owner, he had all the opportunity in the world, which gets back to the management override that you had mentioned in the very beginning, Mark, and we'll come back to that again later. And so understanding the fraud triangle then helps us to develop that professional skepticism, and so it's sort of background information for us. It's good knowledge for us as auditors to have. And I guess my question for you, Mark, is that this fraud triangle is part of that new standard. How does it work itself out in that new standard? Are you telling me that now, in what way is it used in the new standard?
Well, it's actually used really to set up a framework for the entire standard. Going back to the brainstorming and the professional skepticism discussions, part of that discussion will be what would be some of the incentives, what would be some of the opportunities, and to what extent are we observing any kind of conditions related to the management's attitude about financial reporting as a process. In Jack's case, He obviously didn't have much regard for the financial reporting process. That would be the kind of thing we might talk about in this brainstorming discussion, is to what extent do they even appreciate the importance of presenting financial results to external parties like the bank. So it will really set a culture, provide a framework rather for that early on meeting. But where it really comes through in the standard is in the organization of risk factors. In SAS 82, the risk factors were organized along management's characteristics, operating characteristics, industry characteristics, which provides some way of structuring them, but this new structuring them along the triangle of incentive, opportunities, attitudes, and having the risk factors categorized and presented in the standard that way, hopefully will help auditors in the risk assessment phase of when they see a risk condition, they're seeing it under an incentive. When it starts stacking up with lots of opportunities and some elements of attitude rationalization, then hopefully I'm more sensitive to this may be a condition where fraud risk is more likely.
Right.
So it really is the entire presentation of assessing risk in this framework.
Yeah, it's a nice cohesive framework. It all sort of ties together.
Right, and actually there's been some research that's been done since the ASB's Commission of Research that I should just throw in here, and that the research has been looking at presenting it along this triangle perspective, and the research shows that auditors are much more likely to identify the fraud risk condition when you use this framework than the old framework.
That is.
So it's suggesting that it actually does affect auditor performance.
Yeah, and that was my question for you, Joanne, which is the first time that I came across the fraud triangle, a light sort of went on. I said, oh, now I get it. It's when I was doing work on SAS 82. And I guess for me, being the old school auditor, when I saw this thing, first of all, it was easy to understand, and second of all, it really helped shape my thinking about fraud and how to understand it. And I guess, as a practitioner who will be helping your staff, working with them to implement this stuff, do you see this triangle as being a useful sort of framework and tool?
I definitely see that. I see that it's an incredible common sense approach, which is so important because you're taking that look when you're talking about the client. You're really talking about it in a much more practical framework. It's understandable because it's almost like how we think in our day-to-day thought process about people and about our relationships with people. And it's not taking it out of it and putting more, it's less scientific in a sense, it's more practical in an approach, and that's really, in a very basic sense, the way we get to answers so many times is just to be practical.
Uh-huh.
Mike, one thing that when I speak on this, it's sort of like the medical profession. When you think about a doctor, you come in with a disease, a patient does. Fraud is a disease. I mean, it's an element of a disease. And if you think about how a doctor looks at things, you look at symptoms of the condition and then try to diagnose what could be the potential illness here. And this, to me, sets it up where the symptoms are more logically organized so that hopefully we're more able to recognize it.
In segment 3, Mike, Joanne, Mark, and Elliot will discuss the audit team's discussion of fraud risks, as well as how the auditor obtains the information needed to identify fraud risks.
We spent a lot of time today talking about the brainstorming session that audit engagement teams are now required to perform during the planning phase of their audit. We're going to return to our case study now, and we're going to take a look at the brainstorming session that Norma and John and Jenny conducted before they went in to do their audit. You'll get a chance to see how the brainstorming could have worked and fortunately did not, and the way that it actually did work and how that led ultimately to their being able to discover this fraudulent financial reporting. So now we're going to cut back to the second segment of the video and take a look at that brainstorming session.
John should be here.
So the memo said we have to do all these brainstorming sessions before all of our audits.
Uh-huh.
I think that's a really good idea.
Really?
When I was in business school, we used to work case studies in teams, kind of brainstorm about marketing or business strategy, and I really liked it. If you got on a good team, then everyone was very supportive of one another, and you'd end up with a lot of good ideas that you couldn't come up with on your own. If that means we're finding fraud, then it means we're doing a better job. What do you think?
Of what?
The brainstorming.
I'm certainly willing to give it a try. I don't know how I'm supposed to get the warm glow from a brainstorming session, though. I like to see hard documentation. That's auditing. I'm not sure how effective brainstorming is as an audit procedure. Maybe I'm being old-fashioned. I'll give it the old college try.
Have you ever been in one?
Brainstorming? They had one for the firm partners a few years back. They brought in a consultant to help us think of creative ways to recruit and retain staff.
It looks like you didn't have that good a time.
I was just thinking what our fraud brainstorming sessions would be like if they were the same as our recruiting brainstorming.
Okay, the last one here is inventory theft. And what I was thinking was that, well, the nature of the inventory is high value, easy to resell, easy to move. For this, I was thinking that we'd do some analytics of inventory shrinkage over the past few years to see if there's been any big changes.
What about internal controls? Should we check on how they safeguard assets?
We already checked that as part of the IC4 checklist. Plus, we're not relying on controls in inventory, so we don't want to spend any time testing them.
What about revenue recognition? Let's put that on our list. It's required by the SAS.
Okay, but I think we've got that covered in our disclosure checklist. And the revenue form, RV2. I mean, I think.
You read these things in the paper about fictitious sales and customers. What if that's what's happening at Sound Machine? Do we test for that?
The risk is low. I mean, this isn't a public company where we're worried about over-reporting income. I mean, if anything, Jack Atherton would want to under-report revenues to lower his taxes.
What are we doing to test that?
Cut off work, analytical procedures, look at the sales returns and credit memos after year end. I mean, I suppose we could do something else. Any ideas? Well, okay then.
I'm sure this session will be a lot more productive than the last one.
I'm sorry, I'm late. I was working on the rules. Norma asked me to plan the brainstorming, so I did a little research and came up with a few rules.
Well, can you explain them to us? I'd hate to start breaking the rules.
Well, first, I want to remind everyone why we're here. I mean, the purpose of this session is to brainstorm some ideas about how and where Sound Machine is susceptible to fraud. We're not here to solve the problems. Usually when we get together as auditors, we talk about an issue and immediately try to solve it. Well, that's not what we're doing here. We're trying to create scenarios, not solutions.
That's what your last bullet point. Think like a fraudster, not like an auditor. That's what that means?
Exactly.
If we create all these fraud scenarios, when do we solve them?
Well, that's the subject of our audit planning meeting. Whatever we come with today will feed into our planning meeting, and we'll have to design our audit procedures to address the issues we identified today. But I just want to make sure that today we don't default into the problem-solving mode, because that's not our objective.
No such thing as a bad idea.
Yeah. I mean, I think we should all feel free to share any idea we can. I mean, turn off your internal censor and just generate ideas. That's the second rule. Let's go for quantity of ideas. So, let's get started. You know, I was trying to figure out how to think like a fraudster, and here's what I came up with. Do you remember the movie The Sting with Robert Redford and Paul Newman?
I've never heard of it.
Oh, well, it came out a long time ago.
Watch it. I was in the 7th grade.
But like I said, it wasn't that long ago. Anyway, Robert Redford and Paul Newman are these con men. And the bad guy is this guy, Doyle Lonigan.
Robert Shaw.
Yeah, the same guy from Jaws.
He was a big star back in the silent film era when I was going to movies.
Well, this guy, Lonigan, is a real nasty, ruthless gangster. And he kills Robert Redford's best friend and mentor, who happens to be the ex-partner of Paul Newman, and is totally revered in the world of Chicago grifters. So Newman gets his gang of con men together, and they decide that they're going to get even with Lonigan. They're going to hit him where it really hurts. They're going to steal his money. So there's a scene with about 6 con men sitting around a table trying to figure out how to take down Lonigan. What are his weak spots? He doesn't have the usual vices, no women, doesn't play cards or bet the ponies, too sophisticated for securities fraud. And then someone says that Lonergan plays high-stakes poker and he cheats. They also describe him as vindictive and, well, all those things, the card game, the cheating, the drive for revenge, those are Lonergan's weak points. And that's how Redford and Newman build the sting to exploit those weaknesses.
So who are we in this game?
Redford and Newman. Our Mark, the guy we're trying to con is Jack Atherton. I mean, and forget for the minute that we know Jack and he's a nice guy. Pretend that he's like Lonergan, like he's really nasty. And what we want to do is take his money. Take it from Sound Machine. But how do we do it? I mean, where is he vulnerable? Oh, and the other thing? Like Newman says, when it's over, he can't know you took him. We got to take his money and then cover it up so no one knows.
This sounds like a real good movie.
It is. I've been thinking.
You certainly have been.
You know what my ideal job would be? Irene Cohn's. Oh, think about it. I mean, all she has to do is write a check to herself, take it to the bank and cash it. I mean, could it get any easier?
How would you keep from getting caught?
She's the only one who ever looks at the bank statements. All she has to do is take the canceled check, the one made out to herself, pull it from the bank statement, and rip it up.
Plus, as the bookkeeper, she makes the journal entry. So she makes the check out to herself, debits, I don't know, inventory, and we never catch it either.
Okay, I get it. You know what I'd like to do if I could steal from Sound Machine? I'd like to get a new television.
Hang on just a second, Jenny. I'm going to write our ideas on the board so we won't forget them. And then maybe later we can come up with some other ideas like which accounts are the best to debit.
I think we're missing something. Those big screen TVs are huge. How do you physically move it out of the warehouse and not get caught by the video surveillance camera? And none of that Mission Impossible stuff. I'm serious.
You take it from the dock before it even makes it to the warehouse.
You have the truck driver take some inventory to another location before he gets to the warehouse. My brother drove a truck in college and some guys tried to bribe him once.
You're talking collusion.
Yes.
Wow, he's like a felon. I'm talking to a relative of an unindicted co-conspirator.
No, he didn't take the bribe. He used to deliver children's furniture, and someone at his store offered him $500 to deliver a bedroom set to his house.
And when your brother arrived at the store, the person who offered him the bribe would sign a receiving report that said 5 bedroom sets were delivered.
Even though there were only 4.
Right.
How do you hide that from the auditors?
Oh, it's just a book to physical adjustment.
So you don't even need a journal entry to hide it.
Correct.
See that third idea on the board?
Paying fictitious vendors?
I was thinking our thief. Wouldn't he...
Why does he always have to be a he?
Why would he or she run everything through inventory? You're covering up the fraud with a fake journal entry. But why debit inventory and run the risk of having a big book to physical adjustment that gets our attention?
So if she was smart...
Maybe spread it around to several accounts.
So it's 4 small numbers instead of 1 big one.
Just a thought.
Write that on the board.
Oh, good plan.
I think that's a really good idea, John. You'd make a good crook.
Thank you.
If I wanted to increase profits, I'd just capitalize on some expenses. Like we were saying before, don't do it in one big entry, just a bunch of small ones. All we do is analyticals on expenses, and we scope the fixed asset additions.
Yeah, but we never catch it.
This discussion is scary. What about revenue recognition?
You read these things in the paper about fictitious sales and customers. What if that's happening at Sound Machine?
Or side agreements.
Or sales terms we don't know about.
How would you hide it? What if we send confirms to the fictitious customers?
Collusion. If it's a fake sale to a real customer, you call the customer and you tell him to just sign the audit confirmation.
You'd do the same thing if you had side agreements. Just call the customer.
Yeah, but what about the receivable? I mean, if it's a phony sale, you'll never collect.
Write it off.
But write it off in April or May, after we're done with the audit. That way it's not part of our test work.
Yeah, but what about the aging?
What do you mean?
Well, we're out there in March and you haven't written off the receivables yet, so they're sitting on the books aging. By March, they're going to show up as 90, maybe 120 days past due. I mean, we're going to ask about it. So how do you keep us from finding that?
When the auditors ask, give them all the phony supporting documents and figure there'll be enough for the work papers. Tell them what they want to hear and make them go away.
Would we do that?
You could change the aging somehow so it doesn't show as past due.
That would work.
Welcome back to our panel discussion. Mark, I'd like to direct the first question to you. And we had been talking earlier, both on and before the session, about how important this brainstorming session is to the new standard. And I just want to ask you, when the task force was going through this, what were you thinking? What was your intent for how people would actually implement it? What was your vision for how these sessions would proceed?
Okay. Well, initially, part of the intent, I think, started with what was coming out of some of the research, that when you look at what practitioners are really doing under SAS 82 is still where we're going through the audit and then we get to the fraud risk assessment phase. And it's sort of like we jump over and do this red flags checklist or risk factors checklist, and then we come back into the engagement. So even under SAS 82, it was like a sidestep to consider fraud. And what we were realizing is there's a broader process that really needs to be occurring. Some of the research even showed that if auditors just use a checklist, they actually underperform in the risk assessment phase those that did not have the access to a checklist. So the checklist in some cases of looking at fraud, the sort of step out of the box, come back in, was a distractor. But that they were most effective above all categories if you gave them a risk factors checklist, but then there was an open-ended aspect to that checklist where they were having to step out of the box and to think on their own about what specific conditions could be present at this client. And I think it was that research finding that said, that's an element of brainstorming, really. Mm-hmm. And that we'd be much more effective if the team shared and we had a dialogue between the key people on the engagement team to share that information and to go through that open-ended aspect of brainstorming about incentives, opportunities, and attitudes specific to this client. Mm-hmm. Think about the engagement lead person, the manager or partner has gone through a lot with client continuance or retention decisions to renewal the engagement. There's so much information that person has that maybe the other members of the team don't have, so there's a sharing and exchange of ideas and information. And so I think the idea was to broaden the process beyond much more than a risk factors assessment phase only.
Yeah, and as I watch, a television show, a detective show, you see these detectives bounce ideas off of each other all the time, as they're investigating crimes and, things like that. And, Elliot, I guess I'd like to ask you, as someone who's done, spent a lot of time with fraud investigation, financial fraud investigation, are these brainstorming sessions, are those some of the things that you do to help sort of figure out what could have gone wrong here, or start this process of understanding the entity's vulnerabilities to fraud?
Oh, absolutely. This is what this aspect does is adopts a lot of the things that we employ in law enforcement, as well as in being a CPA who specializes in fraud. And these are the types of things that we do as a matter of course, as routine. And of course, you're going to have a high degree of skepticism going into an engagement. You're going to go in there and immediately start looking for leads on where the possible fraud could be within whatever entity you're examining. Well, that's what the brainstorming session is asking you to do, is to take a look at this entity and think about the possible or possibility of fraud within the entity. Where could it be? What factors may contribute to it? Would it be a fraud that would be something where the entity itself would be the victim, or could it be a management type fraud that's being perpetrated by the entity itself? So, in the fraud area, these are the types of things that we use as a standard course.
Yeah. And something else that I'm curious about is in your implementation efforts within your firm and in your training of your partners and managers, have you gotten much resistance and pushback on this thing? What sort of response do you get when you say that the new standard requires you to have a brainstorming session? I'm just curious what people say.
Well, it's very interesting, you know, and there's no consistent response throughout my firm, but there is some concern in that being we've got global clients, and in some of these cases it's impractical to think that we're going to be able to get everyone together for a brainstorming session from around the world when we're working an engagement. So they're going to have to employ video conferencing, conference calls, and the brainstorming session's not going to have the face-to-face quality that we would really like it to have. So we've had to basically impress upon them that no matter what venue it is that's being used, you have to set that tone. You have to take that as the opportunity to create that open and honest communication between the staff.
Yeah, that's. I'm glad that you mentioned set the tone, because that's come up a couple of times, and I think that as CPAs, we go into a meeting and we're used to maybe coming out with a list, a to-do list, and having procedures. And it's all very linear and left brain and everything, and this is what we're going to do. And it seems to me, though, that a major objective of this brainstorming is not to come up with the to-do list, but it's to just set the mindset for people and to get them talking about it so that they go into the engagement with that proper questioning mind. Now, Joanne, and I've also seen some sole practitioners that have had the exact opposite problem, and they've asked me, well, how am I supposed to have a brainstorming session with myself? And that's a different kind of logistical problem. But Joanne, I'd like to ask you then, for your firm, and you've got 100 people in your firm. What are your thoughts on this brainstorming session that's required and some of the implementation issues that might arise?
Well, I think that one of the things that we have obviously a benefit to, and that is that we will be able to get staff together and we will be able to talk because the firm has, as its nature, a very open policy about staff talking to senior staff, to partners, much more of an open door availability. People are available to talk to each other. That kind of dialogue doesn't have to just go on one afternoon during a brainstorming session. It can continue. So we want to have some objectives that we accomplish during the brainstorming session, but then it's open-ended after that, because you really do need, as you implement this standard, you really do need an ability to come back and say, are we heading in the right direction with each client? Because it's going to be a new thing each time, a new discussion each time, and you're going to get smarter each time. But you want to be able to come back and revisit problem areas. You want
right. And it's an iterative process, and it sort of builds on itself. And I think the other thing that in some instances it might be a culture shift. In your firm, you say you already have this sort of open culture where people feel free, and that's great to have that kind of exchange and that sort of environment that encourages that sort of exchange.
Mike, and I think the success of this whole brainstorming really will be riding on the shoulders of the engagement lead, manager, or partner, really placing a key amount of emphasis on this activity, that it's not viewed as, okay, the standard says I have to do it, therefore we're going to do it, but rather they really buy into the idea and the benefits of it. Because I really do think, personally, that this brainstorming session could have one of the most substantial impacts on auditor performance in this area, because it helps set that mindset and sets that culture.
Well, and it can go further than just dealing with the issue of fraud.
Absolutely.
It really is a whole process in terms of thinking about the audit in a very different way instead of a step-by-step process.
I think even you mentioned earlier analytics.
Yes.
Here's a great opportunity to set expectations of what those relationships should look like before I ever start looking at trends year to year.
Right.
Here's an opportunity to get everybody's expectations that I think would improve analytical procedure performance, not necessarily just in the fraud setting.
Right. something else that's part of this new standard is the expanded inquiries of management. And there's a couple of issues that I'd like to talk about here. And one is just, Mark, if you could sort of walk us through what those expanded inquiries were. And then, Elliot, I'd like to turn to you and maybe provide us some insight on the effectiveness of inquiries. Because I think as auditors, or certainly as a staff person, you get in there and you want to do something tangible. You want to vouch. You want to tick and tie. You want to see things. And you don't necessarily think of inquiries as being, an audit procedure per se. It's just something that you do to help you perform a procedure. And so, I want to talk about the effectiveness of inquiries as a means of detecting material misstatements due to fraud. But first, Mark, I'd like to turn to you and tell us, the audience, a little bit more about some of the expanded inquiries that the new standard requires.
Okay. The inquiries really relate to 4 different sort of groups of people, I would say. First is just management, speaking to management, talking to them, and asking a series of questions that particularly focus in on the fraud risk, starting with, to what extent are they monitoring fraud risk and how do they view that risk within their own organization? Secondly, are they aware? Have they had situations where employees have provided information that may suggest some certain fraud risk conditions? Are they aware of any kind of issues that have been bubbling up as far as opportunities through weak internal controls? But then the other group that we would include would be the board and the audit committee, having discussions with them and making some inquiries of them as to what extent are they monitoring fraud risk, to what extent are they having discussions with management about risk in this particular organization. The third group being internal audit, if there is a function, internal audit risk and what they're doing as far as assessing fraud risk. And again, the standard lays out a series of particular issues to discuss, but it's not meant to be limited to that. I think it's an effective questioning technique that will be something we want to develop. Again, framing them around incentives, opportunities, attitudes, trying to get a sense of information for that. The fourth group, though, that I think really is a change is broadening the set of management that we might think of when we make inquiries. One of the additional inquiries is to other people in the organization at the management level that are outside the financial reporting function. So operations personnel, inventory and warehousing personnel, general counsel, in-house counsel, people like that you might not normally be speaking to, or you are talking to them in the context of doing the inventory observation, but you're not asking them fraud risk issues. Now we'll be talking to them more. In the normal interactions we're having with them, we'll be bringing in some of those inquiries there.
That's great. And Elliot, what about your experience as, a fraud expert and stuff? Is the inquiry as a procedure, how effective is that really?
Well, it's imperative to the process. You've got to do the appropriate inquiry, and one of the things that's interesting about this is that gives you the information that you then are going to analyze, and that collection process puts such an emphasis on our interviewing skills that is something that is the audit field per se has not really specialized in the past. So,
training opportunities for
and so there's some things that when you start talking to people and interviewing that it's going to put a real emphasis on that area. And
one thing to add on these inquiries is that some of the cases have shown that through auditor inquiry, internal audit as well as external auditing, some people to the point of they finally reveal or give you enough information because they are feeling that probing sense through the inquiry phase that discussing it with certain kinds of individuals, it may actually bubble up, or at least more indicators will bubble up.
And I've read situations where the fraud was there and they it gets discovered, somebody gets on the stand and they say, well, why didn't you tell the auditors that this was going on? And their response is what? Nobody asked.
Absolutely.
And and that I think is part of this as well.
On the other side, though, I think that with the smaller clients, a lot of times, because we're asking a lot of very probing questions, and which, when you're dealing with a small client, they may take very personally. And so you have another side to this, and that is, how can you be tactful about this? What kind of approach should you use so that you're not perceived as impugning the client? And that's going to be a real balance, particularly as we're dealing with people who haven't got those sort of interviewing skills. you know,
Right.
we're going to have to develop those, and that's going to be part of implementing this whole standard.
That's a great point. We don't want people to become offensive about it and accusatory and walk in, you know, believing that they immediately are going to start accusing everyone of committing fraud. That's going to alienate the whole relationship. We want, you know, we want them to use good common sense. Just don't believe everything you're told. That's the key to it. Have that level of skepticism present.
That's actually a question that's come up. Why are we asking management? Because when you look at the fraud research, it's typically the CEO, CFO that's involved. So there's been some questioning, why are you talking to just management? Which is part of the reason for broadening it.
Yeah.
The board, the audit committee, internal audit, and operating personnel.
Yeah. And I know when I was out in the field, you know, you pretty much restricted yourself just to the accounting personnel. You know, we never talked to operations. And I was just wanted to ask you, Joanne, is that, you know, when Mark brought up that point about broadening it and operating personnel, when I read this, I said, that is a great idea, because I saw that as a weakness in, you know, my own approach, and I was just wondering what your response was to that.
And you know, again, with smaller clients, you really have a better opportunity to do that, because you know, in small business, the operations sometimes overlaps with the accounting function, and but beyond that, you get a better sense of the business by being able to inquire of the operations side. That also helps you further with the audit, not just in the fraud area.
Yeah. And I think that that's important for people to recognize as well. As they start to implement this stuff, they're going to see, oh, we have to do this, we have to do that, you know, for fraud. Well, you know what? It's going to improve the effectiveness of all your other audit procedures as well. You know, the fact that you have to get out and ask questions of the people in operations, you know, sales and marketing, you know, about certain things, you know, that's going to help you do a better job in other aspects of your audit. Well, we've been talking about inquiries. And right now we have the opportunity to go to the third segment of our case study, in which we get to see John making some inquiries of the bookkeeper at Sound Machine, which is Irene. So we're going to go to that case study right now, and when we get back, we'll pick up our discussion of inquiries and talk about some other technique-oriented issues for making inquiries of clients.
Well, well, look who's here.
Hello, Irene. Long time no see.
How's the baby?
The baby's in first grade now.
No.
Yes. I'm getting old, Irene. I was refereeing her soccer game this weekend, and I pulled a hamstring.
Well, now that you're a hotshot manager, I never see you anymore.
I thought it was about time for me to drop by. No, actually, there's a few audit-type questions I need to ask.
I must be in some sort of trouble.
Oh, no. Just the usual routine inquiries. We just decided as a firm that some of these questions would be more effective if managers asked them. So here I am, just doing my job.
Well, should I answer all yes or all no?
I can't tell you that, Irene. It wouldn't be as much fun. No, seriously, I need about 20 or 30 minutes, but I'd like it to be uninterrupted. Is that okay?
It's early on a Saturday. Hardly anyone's here.
I'd like you to feel free to say whatever's on your mind. Should I shut the door?
Oh, I must really be in trouble.
No. But part of our standard procedures is to ask sensitive questions about things like employee theft and fraud, and I'd like your honest opinion. I'd hate for you not to say something because someone might be in the hall.
Now, when have you ever known me not to say what's on my mind?
Okay. Door stays open. Now first, let me explain what we're doing. I'm trying to understand your internal controls a little bit better. Well, specifically, I'm trying to understand a little bit more about where the system is vulnerable. My purpose isn't to find fault with anyone. What I really want to do is help tailor our audit, make it more efficient and effective by focusing on those areas where the risk of misstatement is greatest. Does that make sense?
Of course.
You've been here a few years, and you're in an important control position, so we thought that you'd be the perfect one to talk to.
I'll do whatever I can to help.
Thanks. I really appreciate it. Now, if you could, refresh my mind. It's been a while since I've been involved in the day-to-day auditing. Has anything about your job responsibilities changed since I've been the senior?
Nothing's changed in 20 years. I'm still responsible for everything.
And by everything you mean?
Keeping the books, reconciling the bank statements, making sure that everyone gets their paperwork to me on time.
What about the procedures themselves? I mean, a bank rec is still a bank rec, but I'm sure that getting the paperwork from everyone has changed.
Yeah, the paperwork's changed. A few years ago.
Let me ask you this. Where do you think the internal controls are most vulnerable to manipulation or fraud?
What do you mean?
Well, suppose that someone wanted to steal something. What would a smart person try to steal because the chances of him being caught were really small?
Is this a trick question? Do you know something I don't?
No. Purely hypothetical. Just to help me plan our audit.
The biggest control risk is me. It's been that way for years.
You? What do you mean?
I reconcile the bank statements. I have check signing authority up to $5,000. I post the journal entries. I could write myself a check for $2,000 or $3,000 and post the entry to any one of a bunch of different accounts. And you'd never find it. Put that in your work papers. I've got nothing to hide.
So what about inventory? I mean, if I worked here and saw these really cool toys, I might try to find a way to get one for free. Could a smart guy walk out of here with a new DVD player without getting caught? So it sounds like everyone has really given a lot of thought to controlling theft of inventory.
Oh, yes. I'm not saying it couldn't be done, but it would be difficult.
You know, this has been really helpful. I've learned a lot that I didn't know before. If I have any follow-up questions, can I give you a call or drop by?
No, John. Only one visit per customer.
Thanks. Oh, one more question for you, and then I'll get out of your hair. Earlier we talked about keeping the books and how you make journal entries. And then when we were talking about payments to fictitious vendors, you told us which accounts someone would want to post those payments to hide them from us. I mean, that was really helpful. The question I have now is this. During this past year, have you been asked to make any unusual entries that you wouldn't normally make?
No, not really.
Well, let's say over the past few years. Have there been any journal entries that are pretty routine now that maybe you didn't have a lot of when I was the senior?
Well, yes, it seems like we have a lot more sales adjustments than we used to.
Tell me about them. What gets adjusted?
Nothing, really. Usually we just reverse the original sale and then rebook it, same amount.
Well, who asked you to make these entries?
Jack.
And what's his explanation?
He just says that you should probably talk to him about those entries.
Oh, sure. Well, do you have any idea of how many of them there are? I mean, the dollar amount or when they occurred, or?
Jack has all those details.
But if we had to ask you for a list of these rebooking transactions, you'd be able to pull one together for us, wouldn't you?
Oh, sure.
One thing that just occurred to me, when these sales get rebooked, how do they show up on the aging? Are they aged based on their original sales date or on the rebook date?
The rebook date.
Okay. This has really been great, Irene. Thanks a lot. I'll have to come by more often.
You should.
Hi, welcome back. We've just seen John interviewing Irene as part of the audit engagement, and we can see now where the engagement is going and how this interview was really critical to the audit team uncovering the misstatement caused by fraud and the side agreements and all that stuff. And so we've seen how inquiry can be a really effective auditing technique. And before we get off this topic of inquiries and interviewing techniques, Elliot, I'd like to turn to you as the one who's the expert in this area. And maybe you could just give us a few quick pointers for auditors who have to conduct these sorts of inquiries now about fraud-related matters, and what your thoughts are for interviewing people.
Well, as we talked about earlier today, you don't want to run in and be accusatory and just start going around saying that there's fraud everywhere. You're just going to put people off if you do that. So probably a good point to remember would be to establish a rapport with the individual that you're interviewing, as we saw happen in the scenario there. Put the person at ease, be conversational, And that will kind of help you as you get into more probing questions as you go along during the interview. One of the keys to good interviewing is being prepared. Go into the interview and have a good set of information so that when you go in there, you know pretty much what some of the things that you're going to be hearing and where you're going to be going with that interview. And you'll have documents and follow-up questions that you can use. Of course, you don't want to use a script because just like using a checklist or something, when you start doing that, you're going to stick to what you've already prepared, and you're not going to get into maybe some of the more probing areas, or you may even miss completely some of the things that are being told because they don't fit into what you're expecting to hear. So you don't want to go in with a concrete mindset. Be able to be flexible and go where the conversation leads you. Now, one of the things that you don't want to do is if you have someone who's talking with you, you certainly don't want to interrupt them. I've seen this happen over and over again where the person will be just, giving the information that's requested, and the interviewer is so intent on asking that next question that they cut them off in the middle of a statement. There may be something very telling that's about to come, so you don't want to do that. One of the other techniques you can use is ask control questions, ones that you know the answer to. That helps you establish the person's credibility. Are they telling you what you already know to be true, or are they giving you some other answer? Are they trying to trick you on those questions? If they are, you know that everything that you're asking them, they probably are doing the same. So those are just a few tips very quickly. There's some great training out there. It takes time to develop a good sense to be a good interviewer. It's really an intuitive process. You can then get into all the nonverbal clues, which is a very telling thing. But most of us know when somebody's lying to us anyway. So you just use the natural rapport that you've built up with the person to try and gauge whether or not they're intending to deceive you.
We're probably not going to be saying, okay, now I'm going to go interview this person about fraud risk. But rather, I've got a lot of questions I'm asking management. This will be an element of my already natural discussion. So I'm probably not going to start off with my fraud risk discussions in all cases. I may be talking about more logistics, and that'll help establish that rapport. I think the broadening of the inquiries that we talked about earlier, one of the benefits of that is in this video we saw John talking to Irene, but we're going to be talking to other people, and it's the corroborating nature of all the responses that we're probably likely going to get the biggest piece of my information. When I talk to Irene and then I go talk to the inventory people, am I hearing the same story? And that sort of going in with that expectation of what I want to hear.
Sure. Yeah. One of the things that I read also about interviewing and inquiry, and this gets back to a point that you had made earlier, Joanne, about the iterative nature of the auditing process, is that Mark, you just said, well, you go over and talk to somebody, then you go over and talk to somebody else. Well, in some of these engagement teams, you're going to go talk to somebody, and somebody else is going to talk to somebody else. So there's a need for a debriefing session afterwards, and discussion among the engagement team about some of the things that they're finding, because at some level you have to start putting the pieces together.
Well, I think that's the key of that brainstorming meeting. Part of that brainstorming is getting people to focus in on the professional skepticism, but it's setting the culture for the engagement. What we're wanting to establish very early on in the engagement is that communication flow between all parties of the team on the audit side. And I think if we set that right culture, then the two parties are going to know and naturally want to share that information. So we're just trying to encourage that kind of dialogue to be always going on through the audit.
And I think we've seen a great example of what Elliot was just explaining, what you don't do, which is cut somebody off so you can get to the next question, which is what I just did here. So Joanne, I'd like to get back to you because you were going to make a point here about this, and so.
Well, I just really think that part and parcel of getting the staff people comfortable with the interviewing process is really, really going to be critical here, because they are the frontline people and they are going to be the ones that have the best ability to do the interviews. So we have to take people who are not skilled at all in these communication processes that they use, that we would be using, and we need to make them very skilled. And I mean, that's going to take some time. And along the way, I think we're going to get a lot better audits coming out of this.
I'm thinking a lot of it will involve early on in the implementation of this, the more senior engagement people, the managers and partners playing a more frontline role in a lot of these discussions, particularly if I'm talking with the CEO or CFO. But there's an opportunity for some training on site. Bring the senior with you to those meetings just to be an observer. It's a great training hands-on in that way.
Okay, up until this point, we've pretty much been laying the groundwork for how we're going to implement the SAS and some of the broad skills and techniques that will be required of us. We've been talking about things like professional skepticism and setting the tone for the engagement and inquiries and the brainstorming session and those sorts of things that have implications that are broad for the entire engagement. I think what we're going to be doing now in this next segment is we're going to be drilling down a little bit deeper into the requirements of the SAS. In the SAS itself, it talks about a process where you first identify risk, then assess the risk, and finally respond to the risk. And so in these upcoming segments, what we'd like to do is we'd like to take each one of those steps in the process and talk about some of the new requirements that this SAS will make upon auditors that were not required in previous standards.
In segment 4, Mike, Joanne, Mark, and Elliot will discuss the auditor's identification of fraud risks.
Okay, I'd like to pick up now on this next discussion, talking about identifying risk, right? Specifically identifying risk of material misstatement due to fraud. And there's a lot of good guidance in the new standard. And Mark, I want to turn to you first, and we want to zero in this section on one specific thing that they've added in this new standard, and that is revenue recognition. Can you tell us a little bit about what the standard says about revenue recognition, some assumptions that we have to make about it, and then some of the other guidance that's included in there?
Okay. You know, when you get down to identifying the risk, we want to emphasize too the broadening of information that we talked about earlier. You're going to have so many inputs coming into the process about the risk, potential factors indicating risk is there. But in the process of developing the standard, again, the research, going back to that, pointed to when you look at the typical case of fraud, most of them involve some aspect of revenue recognition issues, either falsifying revenues or prematurely booking the